Okay. Well, Jameer here tonight. He is going to talk about multifamily home underwriting. Jameer, you want to take away?
Yeah, for sure. So I guess my first question would be, Precious, do you have any experience just with multifamily in general? Looking at it, looking at OMs, talking to brokers, anything.
I've looked at them, but the one broker that I did call when I originally started never got back to me. So I kind of just put all of that on hold. So I haven't reached out to anything on my multifamily list at all.
Okay, cool, cool, cool. Um, so really, that was just a question just to kind of gauge experience. But when it comes to underwriting, really, when it comes to underwriting anything, any like commercial real estate deal, the equation is really just the same. The only differences between the asset classes is how does this specific asset class survive in the real estate world? So, like tonight, we're talking about specifically multifamily, and with multifamily, there are generally different drivers, but the equation is very simple. So simple that I teach my 6-year-old children this equation. I could give them a multitude of assets, whether it be real estate, whether it be businesses, whether it be vending machines. It doesn't matter what kind of asset I give them. They know how to do this equation because it's literally so simple. When I got started in commercial real estate, so I started with multifamily, elevating myself into underwriting, not even just smaller multifamily like 5 to 10, 10 to 20, but also larger assets like 50 to 50 and up. And within that, those still get underwritten a little differently too. And then I also elevated to underwriting industrial properties and underwriting retail properties. And I mean, the equation is generally the same. You're going to need two things plus a third. You're going to need to know how much the property is making. And once you know that, you should also know how much does it cost to operate that asset. And then that's going to give you your cash flow. And I must add, before debt services, because most of the time you have a house, you have any type of real estate, or if you buy in a business, you're going to have some type of debt on that. Because I don't know too many people who, one, can afford it. And if they can, and you making that much money, most of the time you have enough information in your arsenal to say, why would I use my own money? I might as well use OPM. It means other people's money. So you use the bank's money. And then that third piece that I was saying, after you got your income and you got your expenses, you're going to need to cover the debt. And I underwrite properties very simply, so simply that I even stress test it. And what I mean by stress test, there are three major things that you can stress test. One is going to be the expenses. As I said earlier, depending on the size of the multifamily, and I'm saying multifamily specifically because that is what we're talking about tonight. 5 to 10 units, or even 20 a little bit, those expense ratios get underwritten, get stress tested differently than if we're talking about 20 to 40. And then when you go from 40 and up, now you're talking about a different level of expense ratio because generally you're, most people are not operating those 40 plus without a property manager, a professional property manager. Now they understand how to manage these properties. So please put in the chat if you need me to go back, let me know. If I'm moving too fast, let me know. Feel free to ask questions. I'm looking at the chat so I can see any questions. Um, but as I was saying, when you're stress testing, I don't really care too much about what expenses are, depending on no matter what the size. Now, when I go into actual underwriting, then I start wanting to look at the T12, rent roll, all of those things. But I can go on Crexy, I can pull an OM, and I can just look at those because a lot of brokers, they try to gatekeep information, and that's just me being real. I literally, let's see, about 6 weeks ago, I talked to a broker, and I've had brokers send me P&Ls. I had a broker literally tell me that he cannot give me the financials on the property. Like, he cannot. I'm like, what do you mean? In my head, I'm like, what do you mean? He just kept saying, I cannot send those over until you have submitted LOI and it has been accepted. I said, okay, whatever. But Deanna, to your question, OM is offering memorandum. So let's just say offering memorandum is basically a summary of a property or a deal. So let's just say, for example, you go into LoopNet. Actually, I'm going to use Crexy. You go into Crexy, you're scrolling through Crexy, and it says view OM. In that OM, you're going to get pictures of the property at the bare minimum. You're going to get pictures of the property. You're going to get the demographics of the area. You're going to get sales comps. You're going to get rent comps. Those are the basics. It is essentially an elaborate flyer for the broker to sell you the deal. So they're saying, hey, check out this property, getting you all excited. And then sometimes, most times in my experience, you get the financials. And I put quotes around that because once you see those financials and then you ask for the T12, the T12 is the trailing 12, which is the expenses and the income over the last 12 months. You get those and you're like, these are not the numbers that you showed in that OM. And you're going to wonder why. I can't tell you why, but I can tell you that the point of the OM is to sell you on the deal, is to say, hey, check this out. This is a good deal. They're going to try and tell you why it's a good deal. And usually if they are not showing you the financials, something is probably wrong with the property, whether it's occupancy, whether it's not operating at a decent level to where it cash flows, because they know that's going to be a hard sell. Like, we're not going to be able to sell something that's not cash flowing. Now, there are some people, some investors who may be willing to buy that, especially if they know where that asset is in a specific market cycle. So those are just things when it comes to the OM. That's essentially what you're looking for. To sum it up, it is the selling point of any real estate property. Your second question is, how are we supposed to evaluate the deal without financials? The only thing, if you don't have any financials, the only thing you can evaluate is the market. And that always should be a starting point. Every deal that I look at, it's a 5-minute process. I haven't even underwritten the deal because underwriting is a much more intense process. But before that, I literally screen it, deal or no deal, period. And if you want, how you get those financials is you're going to have to call the broker if they're not being supplied. Now, you're going to have, regardless, I would advise you want to call the broker regardless. Even if the deal sucks, the deal's not cash flowing, you done screened it, it's not cash flowing, DSCR is poor, whatever it is, unless there is something fundamentally wrong with the market, call that broker. Or even if there's something fundamentally wrong with the market, like there's no job growth, there's no population growth, whatever the case may be, when it comes to commercial real estate, and when I say commercial real estate, I mean for multifamily, anything that is 5 units and up is considered commercial. Any this is a relationship game. There's I don't know of anybody in this space, in commercial space, who is doing this by themselves. Because why do it by yourself? I've heard plenty of times, hey, you do your own deal by yourself, you're going to get exhausted. You probably won't do another deal by yourself. And I've heard that from somebody who did do a deal by himself. So have I experienced it? No, I would never. But you know, you could try if you want to. And I'm just speaking for the United States. So to sum it up, after that long spiel of what do you do, how do you evaluate a deal without financials, you go based on the market itself. Is the population declining? What's job growth? What are the median what is the median income household in this area? Those are just fundamentals, and that's going to tell you, is this a good market to invest in? Like I said, screening deals, that's the first step. You're understanding the market itself, and then you can, once you have that income, you can say, oh, okay, I'm going to stress test this. If it's, let's just say it's 5 to 20, i'm going to do I'm going to say that 30%, I would even do 35% of this, of the income is expenses. If it's still cash flows, and you could definitely be wrong, you want to be wrong. When you like, the important thing to understand about just investing, period, is it has to be able to survive the worst case scenario. I'm very conservative. I will say, okay, 35% of the income, expenses. It's still cash flows. Cool. Next step is your debt. Because yeah, those expenses, it may survive, but once that debt comes into play, that literally, I pulled up a deal. It was a shopping center, pulled it up, ran the financials before the debt, cash flowed very well. And then all of a sudden, we get down to stress testing the debt at 10%, because that could be where we're going, especially depending on your market. And all of a sudden, that deal doesn't survive anymore and no longer cash flows. Now that means that you're going to just be paying to cover whatever that loan is. And unfortunately, depending on the market and depending on the deal itself, banks won't even lend on it. So you're probably going to have to do something creative. If you really like the deal and you really think that you could turn this deal around, you may have a skill set where you've done this before, or you've managed properties and you're like, oh yeah, like I now have the profit and loss statement. I have the T12. I see what these expenses are. I know this market. These expenses shouldn't, like, these are too high of expenses. I could go find somebody else who would do it for cheaper, or whatever the case may be. Maybe the property doesn't even have any reimbursement program for water or whatever utilities. That's money that's not being capitalized on. So those are just different incomes, different strategies that I go through on every single deal to see, okay, if it survives this, I'm gonna move forward. I know, Precious, you were talking about the one multifamily that you looked at when you first started with us. When you call them, they don't pick up. Keep it moving. Most deals are not good deals. That's just unfortunately how it is. Most deals are not good deals. Even if you don't stress test it, they're not good deals. They don't cash flow. At this point in most markets, a lot of people are just trying to sell off something that doesn't work. And it never did work. This is a true story. Took place around May 1st. I had to take a call from a broker in Houston, Texas, and he was going in on this deal. Oh yeah, it's two brothers. They own 9 properties. They're selling the whole portfolio. It's not really doing too well because they're absentee owners. They don't have like professional property management in place. All of this. I said, oh, okay, well, yeah, send it to me. I'll take a look at it. None of them were cash flowing, which means you're just selling this off. Now, I did know the motivation. They realized I don't want to be in real estate. I want to go back and we want to focus on our beer company back in Cali, which is perfectly fine. But the unfortunate part is most people who are getting into this space, they're looking for cash flow at day one. And if that's what you're looking for, then it's not a deal. When it comes to the underwriting aspect, specifically in multifamily, you really, really, it's not just the numbers, it's not just the P&L, it's also the rent roll. The main point of the rent roll is for you to see what the occupancy is. How many people are physically in the building? And then on top of that, you also got to see how many people are actually paying rent. That's another thing, and that's called economic vacancy. And what that essentially means, like I said, is how who's paying rent. And when you start seeing that people have an outstanding balance, when you look at that rent roll, that doesn't just mean that they have an outstanding balance. Because we have to look at this from a business perspective. Because I mean, you're getting into a business, you're kind of buying a business. You're an investor, and you have somebody who is not they're occupying the space, not paying rent. And they keep telling you, I'm gonna get to it. If a tenant kept telling you, I'm gonna pay you next month. So if you're not okay with the tenant not paying you, of course that looks bad. And that means that that's a management problem. So once again, you're proud that property you're paying for management and you're not getting anything out of it because if they're okay, if it seems like it's okay for one tenant to not pay and get away with that, imagine how word spreads fast. They not the only person who knows that they can get away with not paying rent. I've heard plenty of stories. A guy in New York, he invests in Brooklyn because that's where he's from. He had a tenant, and unfortunately in New York, that's a tenant friendly state. And in those type of states, man, it may take you a year to get your tenant out. And so that means for an entire year, you're not making no money off of that door. So there's a lot of people who don't invest in tenant friendly states. There are some people who do. It's all about what you want out of real estate. Um, but really, underwriting, I mean, if we just keeping it simple, it really gets that simple. It comes down to what is the market like. We can talk about market cycles, but we're not going to talk about that right now because you can invest in any cycle. But when you're just underwriting, you can underwrite any property in any state. You always want to look at it's more than the financials. You want to look at how the market's doing. I was on the call. What's going on with this deal? The population is declining. That now the property can still do well, but we're all talking about risk. And the definition of risk is the potential of something bad happening. That's literally what risk is. You look in any dictionary, it's the potential of something happening. So if the market is declining, jobs, population, income, household income, if that stuff is declining, that's a tall tale sign that might not be the area to invest in right now. Maybe in 8 years, because usually cycles take about 8 years to kind of come back up. But yeah, when it comes to underwriting, it's more than just the numbers, but the bare bones of it. If you just left here today, went on Crexy, pulled out an OM, it has the financials, cool. You can underwrite. What is the income, total income? What are the expenses? You can go anywhere to get a mortgage and estimate what the annual mortgage would be on that property. And you can figure out whether that property cash flows. And if it does not cash flow, it doesn't mean that this doesn't work or the real estate space isn't for you. It just means that you're one step closer to finding a property that does work. Trust me, like I said, I can pull out my deal CRM and I can show you all of the properties that have not worked. And it doesn't even have all the properties that I've underwritten. Dave, I did see that you had your hand raised.
Yeah. Hey, Jameer, I appreciate you being here, man. Earlier, you said about the screening the market. Would you only do that when you don't have the T12 or the rent roll or anything like that? Or would you do that on every property?
I screen every single deal.
Do you screen the market on every deal?
Oh, you just talking about the market itself?
You correct. If you don't have the financials.
Yeah. When I mean screening, that means I'm I'm just getting basic information on the market itself. And once again, this depends entirely on the asset class. But for, like, let's just say, because Deanna brought it up, Atlanta, we go in, we get some type of understanding of how the market is behaving. And really you just need three things. You can go online and you can get population information. That's in the Census Bureau. You can get and in the Census Bureau, you can also see what are the trends so far as the income household, and you can also get understanding of population, income, and jobs. You could type that stuff right into Google. Within the first three links, you can get all that information.
Okay. And that's
And
definitely something
unemployment is going to be really, really,
so that's
really important.
similar to jobs, right? Unemployment,
Yep.
yeah.
Yep. Because if there's no jobs, that means people are most likely moving away.
Yeah. Population declining.
Exactly.
You said that is something you do on every deal, pretty much, even though you have the financials, or the financial pretty much gives you that information right off the bat. I know the
Nah,
T12 pretty much tells you if it's like the current rent and all that kind of stuff. The rent roll tells you how much people are in there, but is that something you would still recommend doing before you go to the broker? Like, hey, let's talk.
I'm still talking to the broker, regardless. It doesn't matter whether the market fundamentals are like they're on a decline or the deal's bad. I'm still talking to the broker because, like I said, they become part of your team. Like, we do have underwriter, you have people bringing capital to the table, you have the operators, you have all of those. But even along your journey, they're still a part of your team because
Mm-hmm.
build that relationship. And this is a true story for me. Probably back in April, I have a friend that I met at an event here. I'm in Philly, at an event here in Philly. He tells me literally 2 days before this broker called me. He says, "Hey, if you come across any 4 to 6 units in the area because he lives in Jersey, please let me know. 2 days later, after we had that conversation, a broker in this area calls me telling me about a 6 unit that he had in the Philly area. Now, I don't talk to this broker every day. Every now and again, maybe like once or twice a month, I'll say, hey, just checking in. That's literally how basic your relationship with a broker can become. But once again, this is a relationship game. And how do you build relationships? You just follow up. And everybody who's in my network now, if they haven't seen my work ethic, because you don't see me on a weekly basis, they'll hit me up because, oh, he responds when I send him a deal. And the deal could be crap. I may not have a buyer for that area, but I could open my phone, I could go on my Gmail right now, and there's a broker. Hey, any updates on this deal? I got to get back to him. But the fact that I respond, that is very important to forming these relationships, especially with the brokers, because they're coming in contact with so many people, and they're coming in contact with people who are not looking to go forward with any deal that comes across the table. They just kind of just blowing out hot air. So when you're responding, that's part of building that relationship. Bad deal, good deal, it doesn't matter. I'll come across good deals, and you just continue to follow up. Hey, do you have anything that just came across the table? If you do, please feel free to send it my way. That's it.
You talked about the screening the market. We talked about that and everything. Want to look into that. About the
Tamir,
economy.
remind me, job wise, I think there is certain type of job that they should be focusing on, right? Like it should be a good mix of job instead of just one type, instead of like one like blue collar type. I remember Grant mentioned something like that. So it's not like
Uh,
over concentrated. If something happened, then it's Exodus or something.
yeah. Glad you brought that up because that is important. Uh, you want that area to, like they say, diversify. You want the
Mm-hmm.
job market to be diversified, and there are two that I can think of off the top of my head that keep stable markets. How do we know they keep stable markets? Because if you go into the stock market, they're stable. One is health, and the second one is education. They don't go anywhere. I don't know too many hospitals. I only know one hospital that has shut down. Not too many hospitals shut down. The second thing is not too many universities shut down either. You might get like public schools that shut down. A lot of public schools have shut down in Philly, but you don't get too many universities. Education is super important. Now there are certain industries that give that are for stable markets and a lot of volatility in the population. Those job and those industries, manufacturing, because they rarely go anywhere, and administration. For the sake of this specific call, multifamily, you want to be in a place where there's people and people are coming there. So that's going to be really important. And people come where jobs go and are. Also, many, when you talked about blue collar jobs, there are three. After having an actual conversation with Grant, four, because of where I live, jobs that you always want to keep track of when you're looking at that market. One is Starbucks. The second is Walmart.
Walmart.
The third is Home Depot. And the
Mhm.
fourth is Target. Now, the reason why you want to focus on Starbucks is because Starbucks and Walmart are the main ones. Reason why you want to focus on them? Because they did their homework. They already did the homework for you. So if there's a Walmart, they did the homework. It's a good area. Find a Starbucks, They did their homework. That's a good area. Target for me and Amazon warehouses. Those are blue collar jobs. When you find those, Amazon's not going anywhere. Why? Just like Starbucks and Walmart. They did the homework already. I don't know how many Amazon's warehouses or buildings have popped up in Philadelphia, but it's insane over the last 5 years. Completely insane how many industrial buildings have been bought out by Amazon and now they're just running out of there. So they've done their homework. They're keeping jobs. They're keeping people working. So for blue collar places, yeah, you're going to get class types that are C cash flows. C properties, they cash flow. Then there's nothing wrong with that. Yeah, you might get a few tenants here and there that's a little questionable, but they do cash flow. And you know that people gonna be rolling in. So it's just a matter of, making sure you understand the market and using the cheat sheet of other companies for in multifamily specifically.
Amir, would you have an example that you could maybe pull up and do a live underwriting if you're able to?
I know you asked me to do something live. So we got the question earlier, what is an OM? This is a 64-page OM. We're not going to go all through this. Because the question was there, I wanted to show you. Like I said, you got an executive summary, you got property, market overview, and the comparables. Like I said, the property overview is going to be the pictures. They're going to make this look good. And another thing that we should take note of, look at the order in which this table of contents is laid out. The financial analysis is at the bottom for a specific reason. Can anybody guess why it's last?
They're trying to hide it from you to
They
a certain
are
extent.
definitely, yes, they are hiding. Because look, I mean, it's 64 pages. How many people really want to scroll through 64 pages? What they're going to do is they're going to go through, they're going to scroll. They're not thinking of manually controlling this scroll. They're showing you how awesome the DC market is, the submarket. They're showing you the photos. They're showing new construction, institutional quality. They're giving you all these great buzzwords. They giving you market analysis, which you're still going to do on your own. They're giving you a lay of the land, all that good stuff. See? All of that good stuff. I don't care about that. Any property could look sexy, it could look good, it could look anything. It could look bad. Guess what's important? Page 56. That's what I care about right now. Rent roll. Now, I'm not even looking at this rent roll. And this is legit how I go through this. When I open this OM, this is literally what I do. I don't care about the pictures. I don't care about the market, because all they're trying to do is they're gassing it up. Oh, look at all of this. It's close to here. It's the market is doing this. This is what other properties were selling for. These are the rent comps. This below. Okay, let's see. Now, rent roll basic. All I did when I opened this, I wanted to see how many units, because how many units is the first thing I'm looking for. If I go into Crexy, if I go into LoopNet, I have a specific buy box. I am not looking for anything that is less than 10 units. I'm not looking for anything that's 20 units. I'm not looking for anything that's 30 units. I'm looking for 50 plus units. So that's off the bat. If somebody sent me something and it's 20 units, I literally will send them a message. Hey, I'm looking for deals that are this size. If you don't have it, that's perfectly fine. We'll keep the conversation open. Like I said, this rent roll is only as good as the unit mix. The reason why I say that is because this average rent, I'll figure that out when I get that rent roll and when I get the T12. I will tell you a story about looking at potential in a minute, and it's going to be regarding an industrial property, but it's also just a consistent thing that's going on specifically in Houston, in the Texas market. I say the Texas market because that's been most of the deals that have been sent to me to underwrite lately. This is the part that I'm really looking for. I scroll here immediately after I find out how much it is, what size it is. At that point, I'm coming to the operating statement. That's what I want to know. And this is just basic underwriting so I can create a conversation. I'm looking at income. I gave y'all the equation earlier. The main thing is going to be the EGI, or the effective gross income. I'm going to take that. I don't care what that expense says for a property this size. I'm immediately going to assume that the expenses are 50% of the effective gross income. I have seen this week, last week, and the week before, where I stress tested 50% and the actual expenses were 75%, were 60%, were 65% of the effective gross income. Crazy, crazy. That either means that your rents are too low or you're running the property inefficiently. Essentially, you're paying too much. So if this is in the screening process, I also use AI. But before I even got to AI, I literally came here. What I would do is in my phone, I would type this number right here. So it'd be 1,041,146. I'm going to multiply that by 50%. That would get me 520,573. I just stress tested that off of the bat because of the size of the property, because that's typically what we're going to see. And 520,000, 520 and a half thousand, that's definitely less than your NOI. After I figure that out, then I'm going to divide it by the asking price. I didn't see the asking price, but it's going to be somewhere at the top. Let's see. Nope. Y'all ain't even give me the asking price. So, that's a great point too. This is another reason why they put everything in the order that they did. Because it's hard to get financing on a property. It's hard to find a lender who is going to finance a property that is less than 90%. Let alone less than 80%. You might be able to find somebody who's a lender who's willing to finance something less than 80, that's less than 90%, but greater than 80%. But this is at 79% occupancy. This is a class A. If you look at the year, it was built in 2020. Usually class A's are built within the last 5 to 10 years, 5 to 10 years. I'm looking for the price though. Where's the asking price? That's weird. Come on, Marcus and Miller chat. Never have I seen y'all put the price so low. Here we go. No, that's weird. All right. I'm not going to take too much time looking for our asking price. Let's just say that this property was priced at $8.5 million. So I would take, this is how I'm going to find my cap rate. So first we discover what we're looking for. Buildings that are 5 to 10, 10 to 20, 20 to 40, 40 and up. we checked off, okay, it's 63 units. Next, we found our income. We stress tested our income for this size at 50%. Expense ratio, we got over $520,000. After that, I'm going to find my cap rate. And like I said, let's just say that cap rate is your NOI divided by your asking price. So we got the 520 divided by, like I said, 8.5 million. That's going to give me a cap rate of 6.12%. If you don't know what cap rate is, please put a 2 in the chat. All right, I don't see any 2s. Oh, okay, cool. Deanna, good, great. Because that's an important thing, especially when you're in the once you're in the commercial space. Cap rate is literally just saying, okay, if you bought this property with no debt. So for this property specifically, you and a bunch of other people, or you yourself, you got $8.5 million. You say, hey, we're going to close at this price, at this $8.5 million. And that cap rate is going to say how fast your money is going to grow. Does that make sense? And if we put it in stock terms, they say, okay, the S&P 500 averages 6 to 8% a year. That's exactly what that cap rate is saying. This property is said to average 6.12 of your money a year. So I'm glad that makes sense. So found my cap rate, 6.12%. Now, is that something I'm willing to take on? Most likely not. And the reason would be, depends on what type of investor you are. Why are you investing in this property? Anytime you're thinking about a property or you get into any investment space, your first question should be, what do I want from this experience? Do I want cash flow or do I want appreciation? So if you're going for appreciation, this 6.12 cap rate might be good for you. That's a good appreciation, especially if the market is good. But it's not going to be a good fit, because that also means that you're losing money. And I'm going to get into how we will find out if we're losing money. Because when we get into we go into finding the mortgage. So we got our cash flow before debt services. Now we're going to go and find out what our debt service would be. I'm going to pull up a mortgage calculator. If you have a mortgage calculator on your phone, you could use that. If you don't, you could go on the internet, and there's plenty of them out there. But let's just say we said that the property costs $8.5 million. On average, we could say we're going to put down 25%. This is another area of stress test. There's plenty of areas of stress test. I only wanted to talk about 3 today. I could sit here and talk about all the stress tests that I do before I go to my buyer and say, hey, this is a good deal. Hey, this is a bad deal. Or this is a good deal if you do this. I've done that. So let's just say $8.5 million, down payment of 25%. It's going to most likely be a 30-year term. And for this sake, we could just say that the interest rate is going to be 70%. If I was stress testing this, I stress tested at 10%. If we say that it's going to be at 7%, we're looking at $42,413. So what I would do with that is I would take my 520, 547, I think, and I would divide that by doing that 42,000. I don't forgot the number, but I'm just going to say that it was 331 times 12. And that would give me, this is now our DSCR, and our DSCR is our debt coverage ratio. Debt coverage ratio is how much of the debt can the cash flow cover. And with this specific example, it's going to be at 1.03, which means we're right there. It just covers the amount of debt service that we would be taking on based on the criteria that we put in the loan calculator. Would this be a good deal? If you're going for cash flow, most likely not. Why? Because it's just covering that. And also, when you're going to a bank for a loan, most banks are not going to go with that DSR because they don't want you to just to be able to just cover the debt service. Remember, this is commercial property. And in commercial property, these lenders are not looking specifically at you. They are looking at the property, and this property is considered a business. So in that case, they're saying, oh, this property only as it is right now, because that's all we can deal with is the now. It can only just cover the property. We need it to be able to cover the property plus another 25%. That's playing it safe. Me personally, one, most deals don't cover it. Two, I go for 1.3 because as I've seen plenty of times, expenses are rising in some markets. And I guess this would be another good time for story time. So back in May, I was looking at a property near me, and it was an industrial property. The taxes were going to triple. In the underwriting, I was saying this is when looking into the future matters. This is where it matters. We're not talking about what could be, what rents could be. That's great, but usually rents are going to take about a 5 year. That's a 5 year process. You're not just going to go and say, "Oh, overnight we're going to raise rents 15%." Yeah, good luck keeping those tenants. So with this specific property taxes were going to triple. It was going to go from $76,000 a year to $202,000 a year. That completely ate away at every bit of cash flow. So when I say that this, like as is, if we would have closed on that property this year, I'm saying everything would have been great because yes, I underwrite it from like an underwriting standpoint, but when I want to get into how the leverage is going to be played out over a period of time, and then I start getting into the asset management aspect of it, I'm looking at, okay, what could we do in the future? When would be the best time to sell it? What does the levered debt look like in comparison to, I could go on and on and on about this, but once that property tax tripled, there was no longer any cash flow. And this deal was as is, was at a 9.2 cap rate. You're not going to find too many properties like that in which the deal actually works. You're going to find properties where it's advertised as a 9.2, and I just did earlier this week, cap rate is 9.2, but it doesn't cash flow. So it's a no deal. But this one was a deal. The only thing that took it away was the fact that future property taxes were going to triple. So those are two places where certain things are projected to take your cash flow away if you're getting debt or if you're just purchasing the property, period. It's going to hurt when you in the property taxes and or insurance and in the debt. And the debt can literally kill a deal. So if you don't come to the right terms, I know Dave, you were talking about the seller financing piece. If you don't underwrite that correctly, or the numbers that they're giving you, which is weird, how is the seller giving you terms? Like you, as Sergio says, you can't have your cake and eat it too. We can sell the property, but I'm coming with terms. And if I come up with really good terms for both you and me, you still don't want to take the property. You must not want the property that bad. So that's how I underwrite every deal. I have a scorecard for every single deal. I can actually show you what my scorecard pretty much looks like. My deal CRM is automated at this point. Yeah. This does not encompass every single deal that I've underwritten, but when I was on an underwriting spree, before I got on teams and before I got buyers, this is what it looked like. As you can see, I have column I have the units, and then I have price per unit. I have if it needs renovations, and any column that has color, has like coloring, green or red, that goes into my scorecard. I have what the market rents are. You can Google this, but I wouldn't trust Google, but you can use it as a base. As I said, I get the gross annual rent or the effective gross income. And what I do with that, that's when it gets me my NOI, and automatically in my NOI column, it's stress tested. And I'm going to pull up the formula. Nope, that doesn't have a formula. There it is. So if you come up, if you see in the formula box, it has the gross annual rent divided by 2. That would be the same as multiplying it by 50%. Why? Because we're looking at the deal size. If it was a 7 unit, I'll multiply that by 35%. Just as a stress test, just up front. Because we don't know what expenses are going to be. That's why you want to stress test it up front. You don't know what expenses are going to be. You don't know what those real expenses, those current expenses are, until you get into the due diligence period. And then you might find out, that it was advertised at 25%. But now that we have the T12 and we got all the financial stuff, they're really at 38%. And that's going to be a big shock. And now you're going to want to get out of the deal. And then you don't want to be the person who's known for getting out of deals because things were a shock that you could have stress tested in the beginning. But I also then have this column Q. I have the cap rate based on the NOI that I calculated. None of the cap rates in this column are cap rates that were given to me by the OM or by the broker, because they're going to say what they're going to say. But guess what? When I go in and I calculate this cap rate based off of my stress test, that's what this is. You can see the calculation in the equation bar. And then I find my DSCR, stress testing it. These were stress tested at 7%. As you can see, the ones that are in green are 1.25 and greater. Anything less than 1.25 is a dud. It's a no-go, because by the buyers that I have, they like light value add. They like being able to increase the rent. Why? Well, in multifamily, that's how in anything, that's how you increase the value of the property, because it's a business at the end of the day. So you increase the rent, that means you increase the NOI. That means when you go to sell, you can sell it for a higher price as long as the market is fit for it. And then in column X, I have a whole scorecard. These are off. I'm not sure what happened. I know what happened. This sheet went through some things early on, and certain things didn't come through. But if I change this number to, let's just say 3, it'll stay green. If I change it to 2, it goes red. So I have a scorecard. And this is just the bare basics of my spreadsheet. Before, Dave, we talked about this earlier. if I'm just looking at the financials, I'm not doing any market research, this is it. We got this all laid out, and boom. Haven't even talked to the broker yet. Most of these, I didn't talk to a broker. I just went straight off of the OM, because once again, the OM is there to get buyers elated, especially people who are new to the game.